Nothing could be worse than at this point in your life, you suffering a big loss. You're not going to recover from it. There's something that's worse than the stock market loss. What is it? Because once the market goes down, can't you recover if the market goes back up? But what's the worst thing than a stock market loss? It's high fees. Because if you pay too much fees, is anyone ever going to say, oh, I'm sorry, I charged you too much fees. Here's your fees back. They're going to write you a check? No, it doesn't happen that way. Okay? So why are we talking about it? Well, we're a very unique company in that all of our clients are retirees or soon to be retirees. They've had advisors for 10, 15, 20, 30 years. And they love their advisors. They actually come to us and they feel guilty. They're like, oh, we feel so guilty. We love our advisor. They're so nice. Their office treats us wonderful. We went to dinner. They go to the same church. Our kids hang out. We love our advisor. And I say at that point, well, you must like them because you've had them for 20 years, so they must be a nice person. And they're all animated. And then I say, but now let's talk about your money. And guess what they do? They go like this. Because they know everything about how nice the advisor is. What don't they know anything about? Their own money. They know nothing about their own money. So the first thing we'll ask them is, what are you paying in fees? And they'll answer one of two ways. They'll say, we're paying 1% in fees, and they'll be emphatic about it. Or they'll say, honey, what do you think? I don't know, honey, what do you think? Maybe 1%? Guess what both answers mean? They have no idea what they're paying in fees. That's all it means. They're just trying to answer. We understand that. So they could be paying the advisor 1%, but then we look at their statements, and they have these big fat 20, 30, 40, 50, 80-page statements. Do any of them understand their statements? No. And then they have all these sales being made, and they mostly have mutual funds that are being bought and sold. They don't know why they're being bought and sold. And we ask them, why they're being bought and sold? The client says, we don't know. We say, well, if someone's doing that, is that your advisor? They say, we don't think so. So I said, well, then that means you have a money manager, and you're probably paying 1% to the money manager. Okay? Then we look at their statements, and they have all these mutual funds. 95% of the clients have mutual funds. And I ask them then, what is your average mutual fund expense you're paying? And they say 0. We're not paying anything for mutual fund. Why did they say that? Because their advisor told them they're not paying any of their fees other than the advisor expense. And do the mutual fund expenses show up on their statements? They don't. They don't show up on the statement. Okay? Well, the average mutual fund expense in the United States for equity mutual funds is 1.23%. Doesn't matter whether it's a load or no load, that's the average mutual fund expense. You can find this expense if you're willing to read your favorite book. You know what your favorite books are called? Prospectuses. You love those books, don't you? Those 200-page documents that are rice paper. What if you have 40 mutual funds and each prospectus is 200 pages? Will you read 8,000 pages of data just to try to find out what your fees are? You won't. Okay? But that's the average. Now, there's a worse cost because at least they have to tell you what this cost is by law. Let's say I'm a mutual fund manager and I have a mutual fund and I have 100 stocks inside my mutual fund. Well, there's a few of those I need to sell each year, and then I need to repurchase them to put back in my portfolio, right? What would you guess the average stock portfolio manager sells and then repurchases each year as a percentage of my stocks? What would you guess? What seems reasonable? Does 80% sound reasonable? If I have 100 stocks, does it sound reasonable? I'm selling 80. That's the average. The average turnover ratio is 80%. So if I have $1 billion in my portfolio, I'm going to sell 800 million and I'm going to repurchase 800 million. So I have $1.6 billion of transactions. Is that going to be a little baby cost or a huge cost? Huge cost, and the average is 1.44%. That's hidden. They do not have to tell you what that cost is. Okay? Now, let's say you have what's called an actively traded mutual fund. You don't have an ETF or an index fund, which is all you should be invested in. You have an actively traded mutual fund, meaning they're buying and selling the stocks inside. There's a cash drag because they have to hold cash in the mutual fund to buy and sell those stocks of 0.83%. Okay? So how would you like to think you're paying 1% of fees and you end up paying up to 5.5% in fees? Can you get ahead? Now, when your assets go down more than the stock market goes down or more than you thought they should go down, or when you don't earn the same rate of return, do you think this has anything to do with it? It has a huge amount to do with it. Okay? Because you haven't been told. What if you have a variable annuity, which is the single highest asset cost per year? You could be paying up to 6.5% per year on a variable annuity. Can you get ahead if you're paying 6.5% per year? You can't. Doesn't matter who tells you, yes, you can't. So